So we're actually outperforming the index by a fairly reasonable margin net of fees, despite the fact that we've had some headwinds. And I think that's because we have this balance of offense and defense. We're trying to source total return from these non-traditional sources, and we're trying to basically embrace the idea that rates are entirely unpredictable.
Hello, you're watching Proactive. I'm joined by PT Asset Management CEO Sean Dranfield. We're talking about the Performance Trust Total Returned Bond UCITS ETF. Sean, great to speak with you again. US interest rates still elevated, and the data's getting a bit softer. How are you positioning the ETF to handle rate swings and still protect investors' returns?
Yeah, thanks, Stephen. Pleasure being on with you again. Much appreciated. So absolutely. So the overall level of rates is actually, fairly high. We're talking sort of in the, mid single digits in essence. And that's a good thing, relative to what would have been the case, say, in early 21 when the 10-year Treasury was yielding a mere 51 basis points. Yield is not total return, but it's a good starting point for thinking about what the go forward returns might look like. And, now you have yield levels that are generally much more attractive than they would have been a few years ago, across the entire yield curve. So I think the bond market is actually a more attractive hunting ground generally than it's been for a while. And that's illustrated somewhat by the returns of bond markets year to date as well, which have been, fairly good for bond markets, right? So yeah, I think the yield levels have made hunting a little bit more attractive for us.
Sean, your shape management process challenges the usual yield and duration metrics. In today's rate environment, what does it let you see that traditional bond strategies might miss?
Yeah, no, thank you. So fundamentally, bonds are math-based instruments, unlike equities. And what's really fascinating about bonds is there are mathematical price drivers of bonds that yield and duration don't measure, that you can do the sort of go forward math on. So we're always looking for sort of other potential sources of total return that aren't being measured by yield and duration. So I point to a few right now that I think are quite compelling. So the steepness in the yield curve, particularly at the longer end of the curve, is actually quite attractive right now. And that's true for both treasuries and municipal bonds in the US. So what does that mean? So not only are yield levels elevated, as we discussed previously, but you've also got a lot of slope in the curve. So when you have an upward sloping yield curve that's quite steep, a bond over time as it matures is going to roll down the yield curve. And as we know, when yields go down, the price of a bond goes up. And so when you have a very steep yield curve, that can be a pretty significant contributor to total return that yield and duration aren't measuring. So I'd say on the offensive side, so bonds that help you in a rates down environment, those are two areas that are actually quite attractive mathematically. And then the other thing I would say is, previously when we've talked about like, the fact that it's impossible to predict interest rates. And I typically also say what tends to happen is people use central banks as sort of a proxy for all interest rates, whether that's the Fed, the ECB, the Bank of England. But I would say similarly, what tends to happen in bond world is people use investment grade credit spreads as a proxy for all spreads. And certainly investment grade corporate spreads right now are actually very tight by historic standards. So the extra yield you're getting for the credit risk is pretty meager. Now, that said, there are areas of the market where spreads are actually quite a bit wider, and that provides an extra source of total return. So one area that I would point out there would be sort of double and triple A commercial mortgage-backed securities, where spreads have come in a little, but they're still very, very attractive relative to other credit instruments. And at the top of the capital structure, you're really taking very, very little credit risk. So that's another, I think, attractive source of total return that isn't being measured by both yield and duration.
You run a 50-50 blend of offensive and defensive sectors. In this economic backdrop, how's that balance helping you manage risk and keep the return profile steady?
Yeah, so it's really interesting. So I'd say in the year to date, the market actually has been a bit of a headwind for our methodology. So typically we tend to underperform when rates are going down fairly aggressively, and that's sort of been the case. So up until fairly recently, like the 20 and 30-year part of the curve was actually up through the middle of July. So it was basically a headwind for us. And you'd have all this spread compression in investment grade corporates, but other parts of the spread market weren't compressing. So we're actually outperforming the index by a fairly reasonable margin net of fees, despite the fact that we've had some headwinds. And I think that's because we have this balance of offense and defense. We're trying to source total return from these non-traditional sources, and we're trying to basically embrace the idea that rates are entirely unpredictable. So, today you can buy bonds that are rate insensitive that offer total returns in the 5 to 6% range. For a bond manager, that's a good return, especially if you're not taking any credit risk. And then at the long end of the Treasury curve or the muni curve, where there's a lot of steepness, the total returns are actually very attractive as well. And just to give you like an illustration of that, in a very modest rates down environment, those bonds could deliver double-digit returns. If I think about a treasury, I mean, that's like, better than the average return of an equity, and you're talking about a treasury. And we don't predict rates, but that's sort of the what if of the math. So I think it's a fairly interesting environment when you have that balance of offense and defense because you can deliver nice returns despite the fact that the index and spreads have been a little bit of a headwind for our methodology this year.
So where are you seeing the best total return opportunities right now then, Sean? Treasuries, munis, structured debt, something else?
Yeah. So offensively, certainly the 20-year part of the Treasury curve, we think that's a very attractive spot on the curve because that's where most of the steepness is. And you're looking at, total returns that are fairly attractive. I talked about sort of double-digit returns in a rates down moderate environment. But even today, like if you look at a 3-year Treasury, rates would only have to go down. If rates went down 100 basis points on the 3-year Treasury, they'd only have to go down 6 basis points on the 20-year Treasury for the two bonds to tie. So it's really interesting. And then taxable munis are also another area offensively that we're really compelled by. They have, a little bit of spread over treasuries. So you're typically looking at yields in the 5.5% range. The 20-year Treasury is yielding in the sort of mid to high fours right now. But those are really attractive bonds as well with a ton of steepness in the yield curve. So offensively, those are two areas that we think are very attractive. And then on the defensive side, I mentioned CMBS before, and one structure that we really like are interest-only bonds. So these are bonds that have no principal payment. So as a result, they have very little duration. So all you're doing is you're clipping a coupon for up to 10 years, and it makes those bonds very interest rate insensitive. And those bonds have total returns in the 5 to 6% range as well. And we have a healthy allocation to those bonds. And then other than that, we're buying sort of very short IG credit because spreads are so tight, but you can pick up some really healthy total returns in certain sectors in the corporate bond market right now as well. But we don't want to buy long bonds in the corporate bond market because spreads are so tight. So if spreads widen, a typical 10-year corporate would go down a fair amount. Whereas if you buy a short bond, if spreads widen a little bit, it's going to have a pretty modest impact on the price. So there are some really interesting opportunities, both offensively and defensively right now to create that sort of rate agnostic total return profile at the portfolio level.
Sean, as usual, thank you very much for your insights. Great speaking with you.
Absolutely. Thanks so much, Stephen. Have a good rest of your day.
And you, Sean Dranfield, the CEO of PT Asset Management.